I'm obviously not very close to retirement age, but I'm sure as you do approach retirement, market crashes become a little scarier, but that's why your asset allocation is so important. There are two different phases within your investment horizon before you hit retirement age. That's going to be your wealth accumulation phase and then your wealth preservation phase. It's important to start investing when you're young because then you'll have more time to stay in that wealth accumulation phase. But as you approach retirement, you want to transition into more wealth preservation, which means you're going to want to change your asset allocation to more of a mixture between stocks, bonds, and cash. Whereas in your wealth accumulation phase, you're primarily choosing assets that are going to provide you a higher return. So then you approach retirement age, let's talk about the 4% rule. The 4% rule assumes that you can pull out 4% of your portfolio per year in retirement without running out of money. That assumes an asset allocation of 50% stock and 50% bonds. Those bonds are going to help to hedge against losses in your equities portfolio. So let's say that the stock market crashes 20% in a year that you need to pull money out of your retirement fund. Your portfolio would only drop around 10% because 50% of your portfolio is held in bonds. Now, essentially, that would mean that you would have to live off of 10% less income in that year that the market crashed. But this is where cash becomes important. And again, I am not even relatively close to retirement age, but I listen to a ton of podcasts where they interview wealthy people who are a little bit closer to that retirement date. And cash is a big part of their retirement plan as well. They want to hold, let's say, a year's worth of expenses in cash so that if the market drops, let's say, 20%, they can supplement their retirement fund with the cash that they're holding. I hope this helps, and drop any more questions you have in the comments.